This video I will explain types of mutual funds with real life examples. A mutual fund is an investment where many people pool their money together and a professional called fund manager invests that money. However, not all mutual fund invest the money in the same way. There are different types of mutual funds and each type invest money in different assets such as stocks, bonds or a combination of both. Understanding the type of mutual funds helps investors choose the fund that matches their financial goals and comfort with risk. Fund type 1 is equity mutual funds. Equity mutual funds invest most of their money in stocks of the companies. A stock represents ownership in a company. When the company grows and performs well, the value of the stock may increase. Because stock prices can change frequently, equity mutual funds usually carry higher risk, but they may also provide higher returns over the long term. Now we will see the real life example of equity mutual funds. Imagine investing money in several successful businesses like technology companies, banks, and manufacturing companies. If those businesses grow and become more profitable, your investment value can increase. An equity mutual fund works in the similar way by investing in many different companies. Fund type 2 is debt mutual funds. Debt mutual funds invest in fixed income investments like government bonds, corporate bonds, and treasury bills. A bond is essentially a loan given to a government or company, and the investor earns interest income. Debt funds usually have lower risk compared to equity funds, but they also generally provide lower returns. Now we will see real life example of debt mutual funds. Imagine lending money to trusted friend who promises to return the money with some interest after a certain time. Debt funds work in similar way because they invest in loan issued by governments or companies. Just like a trusted friend repays with interest, governments and companies repay bondholders with regular interest income. Fund type 3 is hybrid mutual funds. Hybrid mutual funds invest in combination of stocks and bonds. Stocks for growth. Part of the money is invested for growth through stocks. Bonds for stability. Another part is invested for stability through bonds. Hybrid funds aim to create balance between risk and stability. Now we will see real life example of hybrid mutual funds. Imagine a farmer who plants two types of crops. One crop grows quickly but has higher risk. Another crop grows steadily and is more stable. By growing both crops, the farmer balances the risk and stability. Hybrid funds follow the same idea by investing in different types of assets. Fund type 4 is index funds. An index fund is a mutual fund that tries to copy the performance of the market index. A market index is a group of selected companies used to measure how the market is performing. Instead of selecting the individual companies, the fund invests in the same companies that are part of the index. Index funds are known for being simple and low cost. Now we will see the real life example of index funds. Imagine a teacher creating a class average score based on the performance of all the students. If most students perform well, the average score increases. An index fund works similarly by following the performance of a group of companies. Just as the class average reflects all students' performance, an index fund reflects the collective performance of all companies in the index. Fund type 5 is ELSS mutual funds. ELSS stands for Equity Linked Savings Scheme. This type of mutual fund mainly invests in stocks, but it also offers tax benefits in many countries. ELSS funds usually require investors to keep their money invested for a specific lock-in period, which means the money cannot be withdrawn for a certain time. Now we will see real-life example of ELSS mutual funds. Imagine putting money into a special saving plan that allows you to reduce your taxes, but you must keep the money invested for a few years. ELSS funds work in similar way. Tax benefits. Reduce your tax liability by investing in ELSS. Lock-in period. Money must remain invested for a specific time period. Equity growth. Primarily invest in stocks for long-term growth potential. Now we will see risk and return. Different mutual fund types have different levels of risk and return. In case of equity mutual funds, it has a higher potential return but a higher risk. In case of debt mutual funds, it is lower risk but usually lower returns. In case of hybrid mutual funds, it is a balanced approach between growth and stability. Choosing the right fund depends on financial goals, investment time period, and comfort with risk. Now we will see the summary. Mutual funds are divided into different types based on where the money is invested. The most common types include equity mutual funds for long-term growth, debt mutual funds for stability and regular income, hybrid mutual funds for balanced investment, index funds that follow the market index, ELSS funds that provide tax benefits. Understanding these types help investors to make better investment decisions.